All right, so here is number 10 on the chapter 23 individual assignment. I'm just going to collapse this so we have more room and we'll just walk through it. So Tannen Products Inc. prepares the following factory overhead cost budget for the trim department. There we can look at all of that information that they provide to us. So we have our variable overhead costs, our fixed overhead costs, and our total factory overhead. So this is the budget, okay? Tannen has available 15,000 hours of monthly productive capacity in the trim department under normal business conditions. During July, the trim department actually used 10,000 hours for production. The actual fixed costs were as budgeted. The actual variable overhead for July was as follows, and it gives us all the actuals. So now they want us to construct an overhead variance report. And so variance just means how our actuals deviated from what we budgeted. And so we're going to enter any favorable variances as negative numbers using a minus sign and unfavorable variances as positive numbers. So what that means, anyway, so you'll see as we kind of go through it, but and it says to round our interim computations to the nearest cent if required. All right. So we'll start with our variable factory overhead costs, and we'll start with indirect factory labor. And our indirect factory labor is given to us right here. So 30,230. That's what we actually spent. And then our budget at actual production, we're going to have to calculate. So we're not going to do the budget, because if we look up here, you can see we budgeted 34,100. But we're not just going to put that here. Instead, we're going to say, well, if we look at our actual production rate, okay, how much would our budget be if we had known, or if we had known that we were only going to do 10,000 hours of actual capacity used? So we have to go through this little process to calculate these items on budget at actual production. So the way we're going to do that, let's see. So we're going to look at these indirect costs, right? Where we were planning these on 15,000. So let me pull up a calculator here to make this a little bit easier. I would probably use Excel if I were doing this, all the time. But I would say there was $34,100 of indirect factory labor that was planned for. And that plan was at $15,000 or 50,000 hours. So if I divide that by 15,000, that tells me how much I was budgeting per hour. And then we are going to actually multiply that by the actual production of 10,000 hours. So if we had budgeted for $2.273333 per hour of production, and we made our budget based on 15,000 hours, then when we put our budget at the actual production, we're going to be using that same 2.273333 per hour, but multiplying that by the actual 10,000 hours we actually did. And so I think, again, it told us to do what? I'm just looking at the round your interim computations to the nearest cent if required. So, and then we're going to put everything here just in actual dollars. So 22,733. So that's the amount of the budget at actual production. If that makes sense, I hope it does. The hard thing about a video is you don't get a chance to actually ask questions, right? So in this case, what we budgeted was way less than what we actually spent. So that variance is going to be unfavorable, right? So if I take 30,230 and subtract 22,733, the difference is $7,497 in unfavorable variance. We can do the same process now for our power and light. So we can see that we budgeted 8,030. Ooh, you know what? I made a mistake. So I used 15,000 because I saw that as the productive capacity. But I think I just noticed up here, it says we expected 11,000 hours. So I think I made a mistake by using 15,000 when I as my basis here, because I looked at productive capacity for the month is 15,000 hours. So I think we're going to change this. So hopefully that's not too confusing. And I can kind of explain how I did that, which is just instead of doing 15,000 hours, we are going to use 11,000 hours. Okay, so I'm going to come back here and I'm going to say my actual cost, I'm sorry, my budgeted cost was 34,100. And our expected or our budgeted amount was 11,000. So that means we budgeted $3.10 per hour of production. And then we're going to say, well, we actually did 10,000. So I'll multiply that by 10,000. So now we're going to see our actual cost was 31,000. So our actual cost of 30,230 minus our budgeted 31,000 is going to give us negative 770, or a favorable variance of 770. So hopefully I didn't confuse you too bad with my error. Sometimes the errors help you learn, right? So let's look at the next one, power and light. So power and light was 8,030 was our budget. Divide that by the 11,000 hours we were expecting. That's 73 cents per hour. Multiply that by the 10,000 hours we actually did, and we get 7,300. So again, we'll look at the actual, which was 7,170, minus the budget at actual production. We'll see we had a favorable variance of 130. So anytime what we budgeted is higher than the actual cost, then we would say that was a favorable variance, right? We spent less than we budgeted. Anytime it's the other way around, where our actual cost is higher than what we budgeted, we would have an unfavorable variance. So indirect materials, 14,300 was the budget. And since that was for 11,000 hours, we'll divide that by 11,000. So $1.30 per hour, multiply that by 10,000, and we get 13,000. We budgeted 13,700. So the difference, 13,700 minus 13,000, we'll see in this case is going to be an unfavorable variance of $700. Now we'll just add all these up to get our actual cost, 30,230. Oh, actually it's given to us right here, 51,100. But then we'll add up our budgeted actual production, 31,000. Whoa, let me hit clear. 31,000 plus 7,300 plus 13,000 gives us 51,300. So overall, it looks like we spent $200 less than what we would have expected to at that actual production level. So that's pretty good. It also tells us, so now we're going to get down into our fixed factory overhead costs. So our total so let's see, Our supervisory salaries, what did it tell us up here in the instructions? Overhead, enter favorable variances. Oh, here we go. The actual fixed costs were as budgeted. Okay, so that's cool. So we're just going to go and say, okay, the depreciation of supervisory salaries, 41,900 was the actual cost, and 41,900 was what the budget should have been. Depreciation of plant equipment, 11,030. Whoops. Insurance and property taxes, 20,570. So our total fixed factory overhead cost, let's see, 73,500. We could also just add those up if we wanted to. And then our total factory overhead cost is just going to be our variable factory overhead cost plus our fixed factory overhead cost. So 51,100 plus 73,500. So our actual cost is 124,600. Our budgeted, you could probably just get from up here, or we can add these up. And I'll just do it to double check, make sure I didn't make any mistakes. Oh, looks like I already have my subtotals. Sorry about that. 51,300 in variable plus 73,500 in fixed. 166,700. Something feels weird about that, right? Because these two should only be off by a couple hundred. So somewhere in here, I made a mistake. Let's do this again. 51,300 total variable plus 73,500 total fixed. 124,800. That smells more like it. See, it's like smelling bad milk. You know, something's off. All right. So our total controllable variances were 700 unfavorable and negative, what is that? 770 plus 130, 900 unfavorable. And so then we'll have our volume variance. Let's see. Oh, no, wait, let's see. This is going to be our net controllable variance. And you can see this is going to be favorable. Okay. Minus 200. So it's just the balance of these two. Okay. Our volume variance. So that's going to be in essence, it's going to be the idle hours. Oh, it has it right here for us. So our volume variance is going to be unfavorable, right? So that's the idle hours at the standard rate for fixed factory overhead. Okay. So the idle hours are the difference, right? We had a 15,000 hour capacity, but we had a 10,000 hour actual use, right? So we had 5,000 idle hours, which just means 5,000 hours where we weren't doing anything, but we still had to pay all those fixed costs. Okay. So our fixed costs didn't change, even though we could have used the factory 5,000 hours more. And so if we had actually done that, it would have been a much more efficient thing. So to find this, to find our volume variance, what we're going to do is, give me a moment to think about this. I think what I'm going to do is I'm going to just figure out my fixed factory overhead rate, okay? Which in this case, I'm going to say this has a productive capacity of, what did we say? 15,000 hours. So I'm going to take my total fixed overhead of 124,800, and divide that by 15,000 hours. So that's $8.32 per hour. Okay. So my idle hours then, that 5,000 hours where we sat idle, times that rate is going to tell me the amount of money, I guess, we lost through those idle hours, that our fixed costs could have been covering an additional 5,000 hours. So I'm going to take that times 5,000, and that's $41,600. And then that difference is the total factory overhead cost variance. And we're going to call this unfavorable, because even though we had this favorable variable variance, we had this really unfavorable idle hours, which is our variance, our volume variance. So this will come out to $41,400, or just the sum of these two numbers. You check my work. You can see it looks like I made a mistake. So let me double check my math. So again, we'll take our, I think I took total, that's what I did. So I took total factory overhead and I divided that to get my fixed rate. I should have taken total fixed factory overhead rate, divide it. So let's try that. 73,500 divided by 15,000 hours gives me $4.90 per hour, times the 5,000 hours under capacity that we were, gives us 24,500. That sounds more like it. And then 24,500 minus 200 is going to be 24,300. So we'll check our work. And now I got it right. So just so you know, even your teacher uses a check sometimes. So don't feel bad about it. Just use it to learn and figure out what you did wrong. I hope this was helpful for number 10. And I hope you have a terrific week.